Hi, this is Skyler with Regan. Today, we're going to do a little bit of a follow-up relative to last week, where agency mortgage bonds are relative to cash. And then we're going to do some really simple bond math to talk about risk reward in the curve right now. So today, let's just start with where bills are in cash. You could see here you're getting about 4.3% across the curve. If we look at agency floating rate notes, we're only getting, and I called out this trade about 3 to 4 months ago when you could get about 20 spread on these. These are floating off of 13-week T-bills, roughly 3-month T-bills. You see you're only getting about 2 to maybe 5 basis points on these floaters because the market is nervous about rates rising further and wants to stay very, very short and wants to take advantage of potentially rising interest rates. But when we look at where we were 3 months ago, 4 months ago, the day before the Fed cut interest rates, the time to actually put that trade on was when the curve was inverted. Okay. Because those bonds, they've moved significantly because these bonds are outstanding for 2 years. Okay. So if you go from here to here, you're getting cash flows for the next 2 years. You're not just getting the front end cash flow. So generally speaking, floaters have maintained value or increased value over this time frame. Their yields are significantly higher today without actually having lost market value. Now, that's not true of, let's say, 3 to 5 year fixed rate bonds, because those have duration. They have fixed rate coupons for the next 3 to 5 years. And you're looking at 75 to 100 basis points of movement times a 3 to 5 year duration. Those bonds have lost, call it 2 to 4.5%. Okay. So the time to have owned floaters was, I don't want to say it's completely past, but it's mostly past. Now you want to move a little bit out into fixed rate paper because the curve's actually a little bit steep. Okay. So that movement has happened. So when we look at where cash is, let's pull up where agency mortgage backs are. Okay. So you can go out and you can buy Fannie Mae 6% coupon agency mortgage backs, which are one of the most liquid instruments on earth next to US Treasuries. These are contracts. They're basically futures that roll every month. You can see here, this bond's trading at 99.22, approximately 99.68. Okay. About a 32-cent discount to par to get a 6% coupon new issue bond. These underlying borrowers are paying roughly a 7% coupon. So these are new issue borrowers. These loans are about 6 months old. So the market's predicting roughly about a 15% prepayment speed, which makes this about a 4-year bond. If prepayments are 0, or let's say 25 or 50 CPR, this is annualized prepayment rate. So the market's assuming that this is a 4.5 year bond. If speeds do pick up precipitously, it's about a 1 to 2 year bond. If speeds, no one ever prepays again, it does extend out to about a 10-year bond. So that's what gives some of mortgage backs their extra spread, because we don't know exactly when this bond's going to pay off, when the underlying borrowers are going to pay off. But regardless, you're getting about a 6 to 6.05% yield, about 170 spread over T-bills. That's extremely compelling. About 100, and you can see the spread here to each node in the curve. Call it 140 spread to the 5-year part of the curve. Pretty compelling, especially relative to where cash is and where corporates are. Let's go over some quick math here. I thought this was interesting because it becomes a little bit more interesting to look at bonds as coupons go up. Yeah, you get higher yield. Yeah, you get the roll down in the curve, but your risk reward changes. Okay. So let's look at when yields were 1%. And this is a very simple spreadsheet. To calculate duration, you can use this duration calculation in Excel. Your inputs basically are price, maturity, coupon. And so you can see here, as the coupon and yield go up on this bond, duration goes down. It becomes less sensitive to interest rates as you're attaining a higher percentage of your income from coupon. Okay? Duration's effectively time weighting your cash flows. So you see here, yield over the next 5 years. I assume two payments per year. That's how treasuries, corporates, munis pay. You get two payments per year. I'm assuming these get issued at par. So I'm assuming your carry is the same as your yield. Okay. I use this metric. I take my yield and I divide it by duration. Call me old fashioned, but I want to get more yield than risk I'm taking on. Okay. Go back to 2021, and I was posting videos in 2021 about, hey, let's prepare for higher interest rates, what you should be owning. But back then, you were only getting 20 basis points of yield per unit of duration, which meant you could only sustain a 20 basis point movement in interest rates before your entire years of carry was wiped out. Okay? So there's two components to fixed income, one of which is carry, the second of which is market value change. Assuming rates don't stay constant, in this scenario over here, I move rates up and down by 100 basis points. You could see these are uniform. Okay. So as your duration goes down, your vol decreases or your movement relative to interest rate decreases. So with a zero coupon versus an 8% coupon, you're going to have higher sensitivity to rates than you would here. But what's really important is total return. Okay. People look at their statements more than once a year, more than once every 5 years. I'm assuming they only look at it once per year. Okay. So this is where we are right now. And I'm going to go back to here. Okay. And it wasn't too long ago. It was only 4 months ago when two of the top fixed income investors in the world were telling investors to go buy 3.5% coupon 5-year bonds. Okay? And I'm going to use this 3% here as a proxy. And you could see, okay, well, what was your upside? Okay. Yeah, maybe you would have made 770 all in, but you had a very decent likelihood of losing money as rates were only 3.5%. And you were taking on a yield duration of only about 75.75 for owning 5-year paper. But here's where we sit today. We're actually right here. But I'm going to concentrate here on this 5% yield because 5-year bonds right now are at about 460. Okay. 460, 470. Okay. So even if rates rise a further 100 basis points, okay, and I'm going to pull that up. Let's look at the 5-year quick. You can go and invest right now at 459. Okay. Even if, and this is implies a 5%, but if rates rise from, let's say, 5% to 6%, you're still going to make money this year. Okay. So if you have clients, your boss isn't going to fire you if you make money this year on your fixed income investment, you're investing at 5. Okay. That's a pretty decent trade to take. Okay. Worst case, if you think your worst case is 100 over or a plus 100, you have some serious asymmetry here. Okay. And, you could be plus 50 basis points, you could be plus 950 basis points. That's a really interesting entry point, especially if you're investing in that agency sector at 6. You can find high yield, you can find non-agency paper at 7, 8, 9%. And it's going to allow you to survive a significant move in interest rates without losing money over the next year. You could see here at 8%. This is where we're investing in some of our investments. You could see here, even if rates go up 100, we're going to make 380. If rates go up 200, you're going to basically break. So as interest rates go higher, coupons go higher, and duration comes down, you have much better asymmetry to the upside. Whereas back when rates were at 1 or 2%, you had asymmetry to the downside. Okay. And you could see that here where, and here's the thing is, as you move down or up in coupon, you have to assign different probabilities. Okay. So your probability back here when interest rates were 1 of rates going down to 0 were less likely than if they go up 1% from that point forward. Now, as rates go higher and we're reaching some type of terminus, you have to assign probabilities of rates going lower as being higher than of rates going higher. Okay. So you have to assign probabilities, and that's what either even further catalyzes that asymmetry or positive convexity in some of these investments. So it's wise to put together a very simple spreadsheet like this, assign probabilities, and that's going to get you to a point where you feel comfortable going into 5, 6, 7% yielding debt. There has to be some point along that in time frame and steepness of the curve where it makes sense. Thanks. This is Skyler with Regan Capital.